Thank you for having us. Give me just 1 second as we get up the presentation. So today's presentation is really going to talk about what's after PPP. There's obviously been a lot of issues addressing the economy and many specific elements of your business. The question is, how can we stop the dramatic decline in our businesses and restart in a much healthier fashion? As was mentioned, here's Ramiro and I's bio. If you do have any questions or comments during the webinar, please feel free to use the chat function and we'll answer it afterwards. And if you have any questions that you want to get in touch with either of us, please send an email to info@mccumbegroup.com, which you can see at the bottom of the screen. So as TFB has been reporting in the prior webinars, the PPP and some of the other government stimulus programs have been great. The problem is they've been slow and they've been insufficient. The expectation is that the new round of funding that just came in Friday will likely be exhausted by the end of this week. And so whether you did or did not receive funding, the reality is you need to start thinking about what's next and how do you run your business to survive and thrive over this period and thereafter. What our focus will be over the short term, what we want to talk about is how do we keep the business in good shape until normal operations resume, whatever that means. And then over the midterm, how do we change our operations to be sustainable in what likely is going to be a deep recession with the new normal? What just came out today that Q1 GDP was down by 5%, and the expectation is that this could be much deeper and worse in the coming quarters. The real takeaway that I want to leave everybody here is that the time to act is now. Stabilizing your business and preparing it for various scenarios is really important. And because cash is limited, every day that you delay could potentially jeopardize your ability to survive or to capitalize upon different opportunities that might emerge. So one of the most important things I think is important to think about is that cash is your absolute most important thing to manage. It's your lifeline. So it's your first, second, and third priorities. And the reason is because in this environment, banks are unlikely to lend you additional capital if you were to run out. And while there's external resources available, those are likely going to take time and are likely going to be extremely difficult to obtain. So you need to manage your business very similar to how TFB talks about with their clients. You need to manage your business thinking about like as if you were entering retirement age, right? You've got a finite amount of money and you need to figure out how to stretch out as long as possible. Same thing here. You need to figure out how to conserve your cash to keep your business sustainable independently of external funding sources. When we think about your cash conditions, I think it's really important to think about which sources take priority over cash versus others. And so there's certain elements like paying your people that are going to be the absolute top of the list because people aren't going to continue coming to work if you stop writing their paychecks. And then which ones are things of which we can think strategically about deferring or asking for forbearances and things of which we'll talk a little bit later in the presentation. So specifically with regards to cash flow, I think it's really important to think about the various levers that you can pull to generate or to conserve your cash flow. I like to think about it in two buckets. First and foremost is reducing the amount of cash that exits the business. And then the other bucket is increasing the amount of cash that's coming into the business. So let's start with the first. Reducing your cash outflows. These are some basic things, but I think it's important to think about it holistically. First and foremost is reducing cash expenses. So you may have subscriptions or other things that you might be able to reduce, switching to another vendor that could reduce the cost. All of these things are potential actions. Stretching out your accounts payable. So one of the things that I think is important to think about is looking at your aging of your payables and to see how far out you are with each vendor and how strategic that vendor is to the success of your business and your ability to produce whatever you do produce. Deferring capital expenditures and any long-term projects for the time being most likely is a prudent way to conserve cash. And finally, if necessary, negotiating lease and loan payment forbearances. And we'll talk more about this in depth with Ramiro from his perspective. In terms of cash inflows, one of the easiest sources of cash, if you have available, is to draw from your line of credit. And one of the things that we've been advising a lot of our clients is to think about preemptively drawing some of this line of credit, because as your conditions deteriorate, you may, from a covenant standpoint, not have access to that in the future. So in a lot of ways, it's a very cheap insurance policy, the interest payments you'll be paying. Accelerating receivables. While many of your customers will be in difficult positions just like yourself, there's different actions, staying on top of people, as well as potentially offering discounts for early payment on those invoices. Next, attempting new business models. Some businesses may be severely affected and have a dramatic decline in business. And I think it's imperative to be innovative around what are different ways that we can still sell in a confined economic or lockdown environment. Lastly, selling inventory or non-essential assets, so depleting the inventory you do have and not buying new or as much new amounts. Selling non-essential assets like a big piece of machinery or whatnot could also be a source of raising capital. And lastly, external capital sources are something to look into, but I think it's really important to keep in mind that even under best case scenarios pre-COVID, you typically were looking at a 60+ day period to raise it. So often the quickest external capital source that you're going to find is from yourself or friends and family. So with that, what I'd like to do is turn it over to Ramiro, who can give you the perspective of a bank president of what makes him comfortable and what are the attributes that would make a negotiation more successful if you do need to renegotiate your loans.
Good morning, all. It's a pleasure to be here. I'm going to chat with you a little bit about my perspective as a former bank president and having gone through the 08, 09 crisis and then in 99 and 2000, the dot-com bubble crisis, then the SNL, the 87 crash, the SNL crisis of the SNL commercial real estate crisis of the early 90s. Unfortunately, all these gray hairs are just reminders of all of those economic downturns. So let me give you a little bit of what works and what makes a banker nervous. Let's start with the do's. Now is the time to over-communicate with your banker. I can promise you that you're not going to be aggravating the banker by over-communicating. On the contrary, the banker gets nervous when you disappear and the communication flow isn't there. No matter what the news is, be transparent and be honest. The sooner that the banker hears the difficulties, the better the opportunity to do a workaround and put together a win-win situation. The longer you drag it out, the worse the situation is going to become, and you've also lost credibility with your banker. So I would say that the bad news communicated sooner rather than later. And then when you communicate the bad news, it's not a woe's me communication. Communicate the bad news, but with an actual honest to goodness financial plan. And we'll talk a little bit about that. Let's spend a little bit of time on the don'ts. Don't avoid the phone calls from the bankers. It used to give me comfort when a client of mine would call me around 8:45 in the morning or around 6:15 or 6:30 in the evening, when they knew that in the morning my meetings hadn't started, or if it was 6:15, 6:30, my day was winding down and I'd be available to talk. I can tell you it used to make the hair on my neck stand up when I would call a client and invariably the phone call would be returned at 12:35 when he or she knew that I'd be out to lunch. And they'd leave a message and they'd tell me that they'd be busy in the afternoon. They would try again later, and then I'd get a message at 10 o'clock at night. Don't play that game. It's silly, and it unnerves the banker. Don't misrepresent what's going on. This is not a time for games. This is a time, let's be realistic. Here is what we're facing. And then this was also a common trait that I know frustrates bankers, and that's what I call the trickling of bad news. When you gave your banker some bad news, the banker would work with you, try to modify the loan, look for a solution. Now, the banker can't do that on himself, by himself or herself. That banker needs to go to a credit committee or a credit administrator. He is representing what you are telling him, and the fix is put in. When a banker goes through that, there's credibility on his end that he's putting at stake with his credit administrator. If there's a solution found and then all of a sudden there's another shoe that drops, oh, but wait a minute, I also meant to tell you that this and this happened. Now you've put the banker in a real difficult position. He or she has to go back to their credit administrator or to their loan committee and say, forget what we just talked about, the situation has changed. And when the banker loses credibility, you lose credibility. When we talk about a plan, this is the kind of detail that we're talking about. And I'm not going to bore you by going through all the categories, but it's important to approach your banker with facts. One thing is a conversation of how are things going. Boy, things are going tough. But don't worry about it. We're going to make it. We've made it through tough times before. We're going to make through it again. How are you doing? That's not the conversation that a banker wants to hear, and you lose credibility with that. It's much more effective to come armed with financial projections, realistic financial projections. Your banker is going to be focused more than anything on your cash flow. So realistic cash flow projections will go a long way. The conversation should be, after the greetings, along the lines of, let me tell you what's going on. As a consequence of the downturn, we're going to miss a couple of the covenants on June 30th. Our EBITDA coverage, we're going to miss by X amount. Our debt service coverage, and these are examples, the covenants call for 1.25. Based on the current situation, I project we're going to be at 1.22 times. Specifically, what we're doing, Mr. Banker, and you're going to see it in the projections, we've reduced expenses so much, we plan to continue reducing in these lines of business by so much. In addition to that, we're investing some money into our e-commerce. We expect to pick up 10% more revenue over the next 3 months. That'll get our covenants back in line. And while it may not be June 30th, I expect by July 31st to be in line with your covenants. Now, a conversation like that, as a banker, gave me a lot of comfort as opposed to the howdy-doody generalities. With your financial forecast, don't just forecast a most likely scenario, right? Go ahead and forecast also a downside scenario. What if this doesn't work? And what's going to give your plan a lot of credibility with your banker are predefined metrics that you've put in your plan with predefined actions. If we're not at this number by such and such a date, this is the predefined action that we're going to take. If we've exceeded at this point, this is the predefined action that we're going to take. Even if you make some adjustments because the circumstances may have changed, your banker will be a lot more comfortable knowing that there are predefined benchmarks, that he knows the dates when he can communicate with you and ask you how you're doing vis-a-vis these benchmarks. And more importantly, that if you're not hitting them, you've got already a predefined road that you're going to follow. You're not going to be trying to make it up on the fly.
And one thing just to add here is this is not just for the bankers. These are helpful for you to run your business yourself. And this plan actually can help temper some of the personality traits that we often find with entrepreneurs and business owners, which is an optimism, right? There's this tendency to say, hey, I'm so close, but give me another week, give me another week. And these triggers allow you to have a forcing mechanism to do and to make the decisions before you're in the heat of the battle.
Remember, and this is a mistake that a lot of successful entrepreneurs make, the bank is not an equity partner in your company. They don't get enough interest for that type of risk. From the bank's perspective, they're renting you money, and all they want to do is get principal and interest back. And it's an altogether different game than what an equity investor would do. I always liked to create the mood in my workout situations with clients in the quote, let's not hurt each other type of thing. And I would actually sit down with clients and go through their numbers with them and jointly put together a plan that would work for the customer and would work for the bank. The banker has got some tools in this go around that we didn't have back in 08. And now don't take this as Bible, but just as my own belief based on what I have heard from regulators and other bank executives. I don't believe that the bankers are going to come down as hard as they did on 08 and 09 because the regulators won't be coming down on them as hard as they did in 08 and 09. That's for two reasons. One reason is that the banks are much better capitalized today than they were back in 08 and 09. The second reason is that you all learn from history. Regulators would be the first to admit that for a number of different reasons, they overreacted significantly and consequently forced the banks to overreact significantly. I think, and I've heard it from enough sources now, that the word has been put out to the regulators, don't carry the big stick that you carried in 08 and 09. In terms of your renegotiations with the bankers, it needs to be a 50-50 type of a situation. I can tell you that it used to aggravate me when I was negotiating a workout with a client, and basically that client was positioning everything where I was taking all the risk. Remember, we're not equity investors in your company. So now is the time to talk about maybe an interest-only period, and that's something that bankers are more willing to accept. Loan modifications in the sense that you might back end some principal pay downs at the maturity of the loan, partial payments for a period of X amount of time. I'll give you some inside baseball on the banks and why they may be a lot more willing to work with you. When a loan is remodified, and that used to be called, and this is a banking term, a TDR, troubled debt restructured, the regulators would force you to take big reserves against that. I'm told that they are not going to be as harsh this go around. So what am I saying here? I think that the banker will be a lot more willing to work with you this go around than they were in '08 and '09. To make it easier for the banker, make sure that you present him the facts that we talked about a few slides earlier, as opposed to the general optimism of an entrepreneur of, don't worry about it, I'm going to get through this. We've pretty much covered this slide that you're both aligned on the same principles. And at this point, just some hints about leadership that most of you don't need. But the most important thing to recognize, a mentor of mine told me many years ago, something that most CEOs don't recognize or even think about. When you're the CEO or the leader of a company, literally you're on stage 24 hours a day. And your daily behavior is going to speak volumes to your employees about the condition of the company. If you come in and you're in a panic, that's going to trickle down to your working staff. My suggestion to you is that the tougher it gets, the bigger the smile on your face when you come in. You don't realize it, but when you walk into your plant, depending on how you walk in, there's 6 employees that are saying, you better be careful with so-and-so. Charlie's really in a bad mood today. Now's the time to be on stage. Remember, the more difficult it gets, the bigger the smile. Panic breeds panic, and confidence breeds confidence. Make sure that you convey to your staff that you're confident in them and confident in your business model. Also, now's the time to analyze all of the different activities that take place in your company. All activity costs money. Many companies implement processes and procedures that I promise you today are outdated, but you've been doing this for the last 10 or 12 years. Now's the time to do a thorough review and make sure that I would be checking for every single activity. Is it decreasing expenses or is it increasing revenue? Or is it just something that from a government compliance perspective, you absolutely need to do? If it doesn't fit one of those 3 things, eliminate it. Now's the time to do that. You're going to be faced with a difficult question of, as you reduce expenses, it's easy to reduce the fat, and it's easy not to reduce from the bone. But cutting the muscle and how deep to cut into the muscle before you hit fat is really where you're going to earn your money now. And the best way to get to that is to go through this exercise of analyzing every single activity that takes place in your company. A very important note is that, quote, this too shall pass. But people will remember how you acted. Make sure that as you lay out the process of furloughing workers, are you going to do a furlough? Are you going to do layoffs? Are you going to do reduction in hours? Are you going to do reductions in staff? As you're making all of those decisions, remember that your people are watching who and what you do. And above all, whatever medicine you're giving to your staff, make sure that they see plain and visible that you're taking it yourself. Because what's going to happen is, as I said, this too shall pass, but people will remember what you did. And you don't want to create the ill will that as we get back to a normal environment, your top producers, your most productive employees have lost confidence in you as a leader. They will have alternatives and you will lose them, I promise you. the marginal workers will not have alternatives, and you'll be loaded up with a bunch of marginal producers. I'll turn it back over to David now.
You know, one of the things we talked about was conserving cash, and so reducing expenses, but there's certain areas strategically that I think it's important to potentially increase your investment. One of the areas that's extremely sensitive in these times is cybersecurity. We've heard a number of reports of businesses that have been attacked, and this is not a time that you have the luxury to afford to deal with something like that. So to the extent that you feel like you need to strengthen that area, I'd highly recommend it.
Excuse me for interrupting, David, but folks, take this seriously. This has been, in my opinion, way underreported. Why, I don't know. But the hackers, given the fact that so many people are working from home and that those home networks typically are not very well secured, are having a field day. Down here in Miami, I know of 4 companies that have been hit.
And it's not cheap when that occurs. The other thing I think it's really important to think about is any exposure you have to suppliers. Specifically, if there's a supplier that has a disproportionate impact on what you do and there's not a lot of alternatives, it's really important to be cognizant of what is their financial state and if they're at risk. Because if they are, you may need to strategically add to your inventory of their stock and look very quickly for alternative suppliers. Similarly, from a credit risk standpoint, it's very important. Many your customers are stressed that you look at their credit worthiness before extending any terms. And while it may add some incremental costs, it likely may make sense to start using, for example, credit cards or other facilities that allow other people to take the risk, but allow you to have accelerated cash flow. So I'm just going to go through this slide real quickly.